They tell you anyone can start investing with just $100. They say start small, let it grow, be patient. But what they don't tell you is that most $100 investors never make it. Not because they're lazy, not because they're stupid, but because the game itself is stacked against them from the start. This is the real reason most small investors fail, and how a system built to empower everyone slowly evolved to serve only the few. Every day, someone types into Google, how to turn $100 into $1,000, and they'll find the same lists: high-yield savings accounts, index funds, dividend stocks, maybe a blog, an e-commerce hustle, crypto. It all sounds reasonable, but beneath the advice lies a hard truth no one really talks about. The modern financial system was never designed to help small money grow fast. It was built to preserve big money and reward those who can afford to wait. Over the last 2 decades, the number of publicly listed companies has been cut in half. Half. That means there are fewer places than ever for the average investor to put their money. Lyft, Pinterest, SpaceX, the world's fastest growing companies don't go public anymore. They stay private for years, making their biggest gains long before the public ever sees a ticker symbol. By the time the average investor can buy shares, the real wealth has already been extracted. That's not an accident, it's evolution. In the 1990s, a young company went public to raise capital. It was the natural path for growth. Today, it's the opposite. Staying private is the growth strategy. Private equity firms, hedge funds, and venture capital dominate this hidden landscape. They hold trillions in assets, money that never touches public markets, money that compounds away from the public eye. Meanwhile, the rest of us are left with what's left: ETFs, index funds, and mutual funds built on slower, older companies. Your 401k, it's likely full of them. These are the safe, predictable, mature investments that look solid on paper, but rarely outperform inflation in the long run. You think you're growing wealth, but what you're really doing is preserving it. Barely. Let's get real for a second. If you invest $100 into an S&P 500 index fund, and it grows at 8% a year, you'll have $188 after 1 year. If you add $100 every month for 10 years, you'll end up with about $18,000. It's good, but it's slow. And in a world where rent rises faster than your paycheck and groceries climb every month, slow doesn't feel safe anymore. So people look for shortcuts. They jump into crypto hoping to find the next Bitcoin. They trade options on Robinhood, chasing 1,000% gains overnight. They start drop-shipping businesses, flipping NFTs, trading penny stocks. And for a few lucky ones, it works, for a while. But for most, the cycle ends the same way: burnout, losses, frustration. The truth? It's not about intelligence, it's about access. Because access, not ambition, decides how wealth multiplies. Let's look at the data. Households worth between $250,000 and $1 million saw their portfolios grow about 40% over the last decade. Households worth $20 million to $100 million, almost double that growth. Why? Because they can afford to play the illiquidity game, putting their money into assets that regular investors can't touch. Private equity, hedge funds, venture deals, early-stage real estate projects. Those investments lock up cash for years, but they also deliver the illiquidity premium: higher returns in exchange for patience. Small investors can't wait that long. They need liquidity. They need access. So they end up in the most crowded, lowest-yielding part of the market, the public one. The irony? The very safety that protects them from risk also blocks them from reward. Imagine 2 investors. One is a 25-year-old with $100. The other is a 55-year-old millionaire. The young investor buys an index fund. It grows 8% a year. The millionaire invests in a private real estate fund that pays 20% annually but locks the money up for 5 years. Who wins? The one who can afford to wait. Patience isn't just a virtue, it's a privilege. But it doesn't have to be that way. If you understand the system, if you learn how it works and where the gaps are, you can find your own ways to win, even with small money. Let's start with the basics. When you only have $100, your first goal isn't to multiply, it's to learn. Because knowledge compounds faster than money. Think of your first investment as tuition for financial education. Start with high-yield savings accounts, not for growth, but for discipline. They're FDIC insured, risk-free, and they teach you the rhythm of consistent deposits. You'll learn to separate spending money from investment money. That habit is worth more than any return. Then, move to index funds. These are your slow, steady engines, the base of your financial pyramid. They won't make you rich overnight, but they'll teach you what real compounding feels like. Over time, you'll learn to measure progress in decades, not days. But here's where most small investors go wrong. They stop there. They build their entire strategy on safety, never realizing that safety comes with a hidden tax, opportunity cost. They play not to lose, instead of playing to win. And that mindset keeps them locked in a cycle of mediocrity. So what can you do differently? First, embrace asymmetry. That means finding opportunities where your downside is limited, but your upside is open. For example, fractional real estate investing. Platforms now let you invest as little as $100 in income-producing properties around the world. Hotels in Bali, apartments in Berlin, condos in Dubai. You're not buying the whole building. You're buying a fraction of the income it generates. It's tangible, global, and offers real diversification, the kind that used to belong only to the wealthy. Second, invest in your own skills. That's not a cliche. It's the highest return investment you'll ever make. Learn digital marketing, real estate analysis, negotiation. Those are the skills that let you spot opportunities others miss. Because the truth is, $100 in the right mind can outperform $10,000 in the wrong hands. Third, use technology wisely. Robo-advisors, micro-investing apps, and fintech platforms have finally started to narrow the access gap. They automate diversification, lower fees, and remove emotion, the biggest destroyer of returns. If you don't know where to start, use automation until you do. Still, even with these tools, most small investors fail. And it's not because they pick the wrong stocks or funds. It's because they misunderstand the enemy. The enemy isn't the market, it's time. Big investors win because they can control time. They can hold through bear markets. They can wait out recessions. They can invest in assets that take 5, 10, 15 years to mature. Small investors, living paycheck to paycheck, can't. They're forced to think short term. They need liquidity, so they sacrifice growth. The system punishes short-term thinkers, even if they didn't choose to be that way. Let's take crypto as an example. When Bitcoin was under $1,000, the early adopters weren't necessarily smarter. They just had the luxury of losing money without losing sleep. They could afford to wait. Most small investors, on the other hand, entered late and exited early, buying high, selling low, chasing emotion. They were playing someone else's game. The same story repeats in real estate. While everyday investors save for a 20% down payment, private equity firms buy entire neighborhoods in cash. They don't care if property values dip because they're playing the long game, collecting rent and waiting for appreciation. They can turn crises into discounts. Small investors, they watch from the sidelines, priced out by the very system they're told to join. But here's the twist. That same system is changing. New global investment platforms are opening doors that used to be locked. You can now buy shares of commercial real estate projects in Europe, Asia, or the Middle East with a few clicks. You can lend small amounts to startups, or back renewable energy projects abroad. This is what financial evolution looks like. Decentralization, access, inclusion. But access alone isn't enough. You need perspective. Because access without education just creates new ways to lose money faster. So let's step back. Why do most $100 investors fail? It's not one mistake, it's a pattern of 4. Mistake I cross. Chasing speed instead of strategy. They look for the shortcut. They want to turn $100 into $1,000 in a week. They forget that risk compounds faster than returns. Mistake I cross. Copying instead of thinking. They follow trends, not principles. They buy what others buy, not what they understand. And when the market turns, they have no conviction to stay. Mistake I cross. Avoiding risk completely. Ironically, trying to avoid losses guarantees small returns. Safety feels good, but it kills momentum. Mistake I cross shosh. Ignoring access. They don't realize the real game isn't just about buying assets, it's about buying into networks that provide deal flow, mentorship, insider perspective. Now, if you're watching this and thinking, so what can I do with just $100? Here's the honest answer. You can't buy freedom. Not yet, but you can buy options. You can buy your way into a new mindset. Start by splitting that $100 three ways. $40 into an index or ETF, $30 into a learning platform or course, $30 into something small but scalable, a fractional real estate share, a small online business, a digital tool that saves you time. That's how you turn $100 from a wish into a weapon. Because wealth creation isn't about how much you start with, it's about how you allocate attention. And let's talk about attention, the new currency of modern investing. When everyone is distracted by get-rich-quick schemes, attention is what separates the builders from the gamblers. Smart investors don't chase markets, they study them. They don't panic when prices fall, they double down on understanding. Remember what Kevin Albert from Pantheon said. Slow growth companies dominate the public markets, returns from private equity flow to the rich. That's not just a statement, it's a challenge. If slow growth is all you can access, then you have to play the game differently. Use the slow periods to learn, to build relationships, to position yourself for when the next access window opens. Because markets move in cycles. Today's barriers are tomorrow's invitations. Private equity, for example, used to be a billionaire's club. Now, tokenized investment models are breaking it apart. Fractional ownership of private companies, accessible through regulated platforms. Real estate syndicates are using blockchain to distribute income globally. This isn't science fiction, it's happening right now. So if the old world locked you out, the new one is slowly letting you in. But the question is, will you be ready when it does? Let's face it, there's a reason wealth concentrates. It's not luck, it's not conspiracy, it's structure. The rich can diversify across time, geography, and risk. They can lose money and not lose confidence. They have margin, not just in their portfolios, but in their psychology. The average investor, meanwhile, lives in constant tension. Bills, inflation, fear, noise. Every market dip feels personal. Every headline feels like a threat. And so they overreact. They sell low, buy high, repeat. That's how the system wins. Not through deception, but through distraction. But awareness changes everything. When you understand why the game feels unfair, you stop blaming yourself for playing it wrong. You start designing your own smaller, smarter game, one built around patience, education, and leverage. The goal isn't to beat Wall Street, it's to outlast it. Because markets will crash, trends will die, but knowledge and discipline will compound forever. Let's close with this. The reason most $100 investors fail isn't because they don't try hard enough. It's because they expect money to behave like magic, not like math. They think success is about finding the next big thing, when in reality it's about staying in the game long enough to catch the next big thing when it comes. The future of investing is shifting fast. Global, digital, decentralized. Opportunities will spread wider than ever before, but the fundamentals will never change. Invest in what you understand. Stay patient when others panic. And when the system opens a new door, be ready to walk through it. Because the truth is, $100 is never just $100. It's a seed, and what grows from it depends not on where you plant it, but how long you let it grow. Watch the next video and see how the people who understand where the money's moving next always win. And if you're serious about staying ahead of that shift, hit subscribe. You'll want to see what's coming next. Oh, and if you're thinking of starting your own investing journey, take a look at the link in the description. It's the platform I personally use to explore global markets.